insurance is an interesting subject, and this is Life Insurance Awareness Month, so we are definitely covering the different aspects of life insurance, and we look forward to enlightening you on the basic information of life insurance. And tonight is the misunderstanding of term insurance, and just giving you a basic understanding of term insurance. So today's agenda is simple. I'm going to cover an introduction on term insurance. What is term insurance? How does it work? And then why choose term insurance? And then, of course, the types of term insurance and how much do you need, and the application process. And then we're going to summarize everything and have some key takeaways. So let's get started. Introduction. So, welcome to a practical guide on term insurance. We're going to be really basic on this. So, why it matters. Term insurance matters because protecting your family's financial future is important. And term insurance is a way that you can protect one of the ways you can protect your family's financial future. What you'll learn today is what term insurance is, why it's important, and how to choose the right policy. So what is term insurance? Term insurance is a type of life insurance that provides coverage for a specific period or term. It is what we like to call pure life insurance. So what that means is it pays a death benefit to your beneficiaries if you pass away during the policy term. Unlike other types of insurance, there is no cash value. So it is simply pure protection. So the basics of term insurance is you pay, you pass away, it pays during that period. And the key point is if the insured dies, of course, during that time period, then the death benefit is paid to the beneficiaries. And if not, then there's no payout at maturity. So term is just pure protection. You pay, you get paid. That's the basics of term insurance. So how does it work? You can choose coverage. In other words, in this example, let's say 500,000, and then you get to choose or select the policy term. Term can be written actually from 5 years, 10 years, 20 years, 30 years. Also, it's not on here, but you can do what we call annual renewable term, or ART, and that's a 1-year term that will renew every year. We also have certain carriers that you can do term from anywhere in between. Some carriers have blocks like this that is written here, 10 years or 15 years or 20 years or 30 years. And then there are some carriers where you can write anywhere between from 1 year all the way up to 30 years. So you could write an 18-year term or 14-year term, 12-year term. So term is flexible, and depending on the carrier that you are getting the term insurance with. Didn't need that to pop up. Okay. Yep. So then you pay your regular premiums, whether it's monthly or annually, or you can pay quarterly with some carriers. So it varies how you want to pay for your policy, but that is definitely based on you and how the carrier allows you to pay. If you die within the term, your beneficiary will receive the death benefit. And if you outlive the term, the policy expires and there's no payout. So the big question is, why? Why would you want to do this? Why would you want term insurance? And the simple answer is to protect your family's financial future, like I said in the beginning, because term insurance, as well as life insurance in general, is a great way to protect your family's financial future. So we're going to look at this more in detail. Why? Why choose term insurance? Number one, term insurance is affordable because it's pure protection. There's low premiums than the whole life or the cash value type products because you're not saving any money into the policy or anything. It is just protection for the death benefit. It's simple as well. It's easy to understand, and there's no investment components or anything else going on. It's just pure protection. It's flexible because you can choose a term that matches your life goals. And like I said, we have some carriers now that have even made their term even more flexible where you can do it from 1 year all the way up to 35 years. And you can choose it from, you don't have to do blocks of 5 years, 10 years, 15. You can do, like I said a minute ago, 12-year term or 18 or 31 years. So whatever works and meets your needs. And then you can get high coverage and you can get more protection for less cost. So those are some of the basics of why, or the basics of why term insurance is a good choice and a flexible choice because it can help people and help families get protected. So it is ideal for young families with financial obligations such as mortgage, uh, education expenses or cost or debt. But you can definitely get term insurance at a lower rate um, and help cover in the event that anything happens. And the beauty of it is, um, it is a short-term solution for a long-term problem, is what term insurance is. So individuals with limited budget who need substantial coverage, or a lot of times, if you need coverage for a specific thing for a specific period, you can definitely use term insurance for that coverage. So it has its flexibilities and it's affordable. And like I said, I like it because you can get the high coverage and it's easy to do. So let's look at the types of term insurance. There are a lot of people don't know that there are varying types of term insurance. So there's level term, and that's the most common type. Your premiums and the death benefit remain the same throughout the entire term. So if you get $500,000 worth of coverage and it costs you, for example, $100 a month at your age, then it would stay $100 a month for the 20-year term or 30-year term that you selected, and your death benefit would stay at 500,000. Then there's decreasing term. Decreasing term, the death benefit decreases over the term. This is often used to cover a specific debt like a mortgage, and that decreases over time. So a lot of times, this is one of the primary types of term that is sold for mortgage protection insurance, and it's decreasing term. So what happens is you get a mortgage, and the mortgage company wants you to protect their investment, the mortgage that you have. So they want you to have decreasing term, or they want you to have term or some protection. I won't say term, but they want you to have some protection. And the most cost effective a lot of times is a term policy. And a lot of companies sell you decreasing term to protect the mortgage. So the mortgage may start out at 300,000 as you're paying it down, and your insurance will go down, your death benefit will go down as well. But the price typically stays the same. So that 300 that you started out paying for with your 30-year mortgage, 20 years into the mortgage, and you may owe now, 150,000. So you still have a death benefit of 150,000, but you may still be paying the same $100 that you were paying when you started. So decreasing term, the death benefit is decreasing. Increasing term. Increasing term, the death benefit increases over the term. This is the least common or less common, but can be useful to keep up with inflation. So you can get an increasing term, and typically with the increasing term, not only does the death benefit increase, the monthly premium will increase as well because the cost of insurance is going up with your age on a regular basis. A lot of times, increase in term is written in blocks where it'll increase every 5 years it'll increase, or every 10 years it'll increase. So it is not typically an there is an annual increasing, which is an ART, which I mentioned earlier, but most people, when they do increasing term, it's written in blocks. So these are the basic types of term insurance. And the other one that I mentioned before, I'll say it again, is the annual renewable term, which increases every year. So every year you have a term policy, an annual renewable term, and it is probably the most cost effective term you can get, but it is going to increase every year. But you can start out there, and definitely it can help when you have low funds, but you definitely want to get protected. So, how much do you need? Well, generally, the rule of thumb for life insurance is 10 to 15 times your annual income. And we look at annual income when we're looking at life insurance because um, life insurance is for income replacement. One of the things it's for. So here's the things to consider. You're looking at income replacement and how much income would your family lose in the event, God forbid, of an untimely death. And then debt, you want to look at debt. Do you have a mortgage, car loans, and other significant debts that would be left behind for somebody else to take care of in the event of your untimely death? And then future expenses. Will your family need to cover college tuition or other significant expenses in the future? And definitely, will they need to replace your income? So we look at it. I didn't put it in order on this slide as the way we look at it in the industry, but we use an acronym called the DIME, which is covered on this slide: debt, income, mortgage, and education. So that's a simple way to look at it when you are looking at how much coverage you need, and you look at your dime and look at the debt that you have, 10 times your income, your mortgage, and your kids' college education. That's a simple rule of thumb that will get you there. And the even more simple rule of thumb is if you just say, hey, you can look at 10 to 15 times your annual income, and that'll get you started. And then there are a lot of online calculators that you can use now that'll give you a more precise estimate of how much protection you need. So definitely, if you're interested in term insurance, there are a lot of ways to calculate how much you need, or a lot of opportunities to calculate what you need. So let's look at the application process. It is really, really simple to get an application of life insurance in general, but definitely term insurance. You get a quote from an agent, and you provide them the basic information to get an estimated premium, and then fill out a detailed application form and with your financial information and all of that. And then some companies require medical exams for their term insurance policies. We have carriers that you have no medical, all the way up to they won't do medical till you do 1.5 to $2 million worth of coverage. So it just varies from carrier to carrier if you'll have a medical exam. Some do medical exams on all coverages, so it varies. Then from there, it goes to underwriting, and underwriting does this. They assess your risk and they do that based on your health and your lifestyle. So based on the information you shared on the application, they are going to assess your risk, and then that will give you a premium amount that you would have to pay for the policy. And if approved, you receive your policy and start paying your premiums, and you'll pay those premiums for the life of the term, whatever the term is. And so the application process is simple for term insurance. So let's look at the summary of this and some key takeaways about this term insurance and how it works. Term insurance is a smart choice. And why do we say it's a smart choice? It's a smart choice because it's affordable coverage. It will meet specific financial needs, and you can protect your family's future with limited funds if you have to, because term insurance, like I said, is affordable coverage. And the final thought is this: it's not about planning for your death. It's about providing a safety net for the people you love. And that's what insurance is all about. So a lot of people say, I don't need life insurance. They don't want to plan to die and all of that. But it's not about that. It's not planning for death. It's more about putting something into place in the event, God forbid, because we don't have the crystal ball and we don't know if anything or when anything could happen, then you have to put things in place for the people you love. So the action step is to have a talk with a financial advisor, talk to somebody about it, see what kind of coverage you can get, and see if term insurance is right for you. Now, one of the key things and takeaways that I didn't go over in this presentation, because we write for a lot of carriers that now have living benefits with their term insurance. And I didn't discuss living benefits, but they're a definite bonus to having your term insurance as well. And we're going to do a segment on living benefits in the coming days. So stay tuned for that so that you can put all the knowledge together and understand that with your term, you not only have a death benefit, now in this day and age, you can have a term policy that has living benefits as well that will cover you for a terminal illness, critical injury, chronic illness, and some even cover Alzheimer's and other things that may happen. So term insurance is a flexible choice. It's a affordable choice. It meets a specific need, and it can still put you in a situation where you can protect your family's future. The good thing about term insurance is it is a temporary solution for a permanent problem. And the permanent problem is you needing to protect your family's future. And you can at least do it in a temporary fashion until your finances get to a better situation and you can move into a permanent policy. But don't rule term insurance out, because you can win and continue to help your family with a term insurance product. So I want to tell you guys, thank you for the opportunity, for allowing us to share this information with our community. And we look forward to seeing you in the future very soon. And I'm excited about sharing this and look forward to talking to you guys about the other parts of insurance as we go through Life Insurance Awareness Week. So I'm Eduardo Sprague. My time is up, and I thank you for yours. You guys have a great evening.